first session may be mostly just a refresher for you, since we're not really introducing any new programs. However, we have recently created some training resources and cheat sheets, so to speak, that we will be sharing, and we've had available now on our website, most of them. But just trying to point those out and walk you through those, that may be helpful for everyone, both those that are new and those more experienced. So with that, we hope to make it valuable for everyone. If we could advance the slide. Go ahead. It's not moving. Sorry, I'm just having a little technical difficulty. Okay, so moving to our first slide. The objective of the sessions this afternoon is really to be able to answer some very basic questions. Why should you use the IFA programs? What programs do we offer, and how do they benefit your customers? Do your customers even qualify? And then once you determine that, how would you choose? If they qualify for multiple products and programs, how do you choose which is the best fit? So that's really what, at the end of the day, I hope that you will walk away from this training understanding and being fluent and being able to talk about, think about as you meet with customers over the coming weeks. So that's the learning objective. So before we launch into the details, what programs we have and what benefits they offer, I just want to start by taking a few minutes to make the case for why every lender should want to participate and partner with IFA. And my answer on this question is really broken into two levels. First, at a very high level, you're helping the state and your community. And then in this next slide after this, I will talk to you a little bit more about why it's a good business decision for you and how it brings value to your customers. So at a high level, let me start by sharing with you some key elements of our IFA strategic plan, specifically what is our purpose and our core focus. And our goal here is to enhance the quality of life for Iowans, and we do a lot of things at the Finance Authority. But one of the ways that we want to focus that effort is on making affordable financing available for home and community, and in this case, it's obviously related to homes. To accomplish our mission in the area of home ownership, we choose to deliver value through high-quality partnerships with lenders like you who share our goal of promoting the quality of life in your communities. We talk to all of you on a regular basis, and in the course of reviewing and purchasing loans, and in those conversations, it's clear to us that you're all in the line of work that you're in because you find it rewarding to help people achieve their home ownership goals, and you see that positive impact on individuals and your communities, and it gives meaning to the hard work you're doing. And that's exactly why we're here and why this partnership really helps you do that even more than a lot of the other tools you use in your line of work. We have some special tools to bring even more value, more affordability and resource to your communities. And so that's why, as a partner with IFA, you're an active participant in critically meeting the needs of housing for citizens and communities across Iowa. And that helps to strengthen our economy, it helps create stability for our communities, and it leads to just all sorts of positive multipliers for us. So, congratulations on being a part of this. We are really proud to be doing this work, and we think, that it speaks to all of our values. And so when you choose to work with IFA, I want you to know you're not just helping that one borrower, but you are contributing to a whole cycle that helps generate resources for people across the spectrum of housing needs. So thank you for that. So moving into the second level of why to use our programs. Now this may mean a little bit more specifically honing in on what you do with your customers. This slide lists really three simple ways that IFA brings value to the marketplace. And we're going to talk in more detail about these things as we explain the specifics of our programs. But what you do when you offer IFA programs is you help your customers gain access to affordable mortgage financing, and sometimes it's the best financial deal available to them. And if that's the case, you want to be able to do that. You also are able to provide them funds for down payment and closing costs if they don't have those funds available in their own bank accounts. You're also able to bring them really valuable tax credits that are delivered through IFA only from the federal U.S. Treasury. So when you're able to do these things, you have satisfied customers. They refer their friends and their family, and those customers come back again. So I think that's a really crucial reason why you would want to be involved with our programs. And perhaps the best way to talk about it is to think about what would be missing if you didn't. You would be depriving borrowers potentially of the best financing option available to them. You might be turning them away if they don't have sufficient funds to close without down payment funds. You might be just having them forego the value of our mortgage credit certificates, which are really a tremendous value, worth 50% of the mortgage interest they pay in a given year, up to a maximum of $2,000 for the life of the loan. So if you don't use that and offer that program, your customers would be deprived of a benefit that could reduce their effective interest rate by 50%, as much as 50%. So if you were a borrower and you could choose between a lender who can get them these things and one that can't, which one would you choose? So it's really worth your time to learn about our programs and offer them in a competent fashion so that your customers can get that value, and that sets you apart really from other lenders, and it will help you grow your business. So what are the programs we have available? To accomplish our mission, we engage in really 3 types of activities. The first is affordable mortgage financing, and we have several programs listed above here which offer 30-year fixed rate mortgage financing at competitive interest rates. The purpose of these programs is to make homeownership more affordable and to make lower cost financing available and accessible to more Iowans who might otherwise be able to get it. The second activity we engage in is the provision of grant funds to assist with down payment and closing costs. We have 3 programs in this area, and the first 2 are listed there. The plus, we refer to as the PLUS programs, consist of a $2,500 grant program where a borrower can get that funding in conjunction with a first mortgage. So First Home Plus would be with the First Home Mortgage, and Homes for Iowans Plus would be with the Homes for Iowans Mortgage. And then finally, the third option there we have is the Military Homeownership Assistance Program, which offers $5,000 of grant funds and is funded by the Iowa legislature. The purpose of these programs is to reduce the costs of entering the market, and the funds are provided as grants with no second lien or repayment. However, they're not exactly free, because when you refer to our interest rate page on our website, you would find that those PLUS programs are offered at a higher interest rate. That is not the case with the military grant funds. Those can be coupled with a non-PLUS program and thereby not have a premium on the interest rate. So, but it is important to know that. And at this point, I'd like to just pull up one of my resources. We have our Military Homeownership Assistance brochure. We can make those available for you. But this really lays out in pretty significant detail the requirements of the program, the eligibility for it. It does have a service requirement that's laid out there in bullet points, which I won't read off in detail, but it's basically for those members that had served in the Gulf, either in the first Desert Storm or since the War on Terror, since 9/11. There are some forms that are needed to verify that service, and then they have to be approved prior to closing by IFA. They would need to be used with an IFA mortgage unless you're offering a lower cost mortgage that meets certain criteria, so that would need to be approved. And the home has to be immediately occupied as the primary residence for the person using those funds. So the availability of these funds is limited. As I said, I think earlier, the Iowa legislature appropriates funds for this program each year, has done so for a number of years now, and the funding is limited, so when it runs out, we do end up having to shut down our pipeline, and that can happen. So we'll move back to our slides. And so that's the down payment and closing cost assistance activity that we engage in. There is a third activity that I referenced earlier, which is that we provide federal tax credits called mortgage credit certificates. Our program for that is called the Take Credit Program. We do that for qualified first-time homebuyers, and we use a special authority that's granted by the Federal Treasury to issue these credit certificates to qualified borrowers that entitles them to an annual income tax credit of up to $2,000 per year for the life of their mortgage. This program offers significant long-term benefit to home. It could be worth up to $60,000 over the life of their mortgage, depending on the homebuyer's mortgage and income profile. But this is, by the way, not a deduction. You still would be qualified for a mortgage interest deduction on the balance of the interest, but it's an actual credit, which means it's a dollar-for-dollar offset against a borrower's tax liability, so not just a deduction from their taxable income. So the value is really significant, as I've said, and it's a great program. Now, as we indicated on the training schedule that Beth nicely sent out a few weeks ago that you all got to sign up for this, there is going to be a separate training covering the specifics of our Take Credit program on January 7th, And at that time, we would expect to be launching our 2016 program. This is another program which has limited funding. This, again, is made available annually by the U.S. Treasury, and currently we've exhausted all the funds that were available in 2015. So we do have a certain latent program right now, but we do have authorization from our board already to allocate funds for the program in 2016. And the amount that we expect to have available is enough to fund approximately $80 million of mortgages, which we estimate give average loan size to be about 780 new home buyers next year. So the good news is that's about twice as much funding as we had in 2015, and we think it will have a really positive effect and incent some new home buyers to enter the market and take advantage of that credit. So more to come on that in January, but we do expect to get off the ground running early in 2016 with that, and you can really expect to get a full overview of that program in January, so I won't talk a lot about it today. So the way that we deliver our mortgage financing and invest in mortgages is through a contractual agreement called a mortgage origination agreement, and that's between the participating lender, the finance authority, and our master servicer, the Idaho Housing and Finance Association. So I wanted to just sort of frame that relationship for you in this slide. The whole process begins with a qualified home buyer approaching a lender for financing. That lender hopefully is a participating lender. They take the standard loan application. If they determine that a borrower meets the criteria for one of our programs, they lock the rate with IFA, but then underwrite the loan just as with any other investor, fund the loan at closing, and then only after that point in time would they deliver the loan to the master servicer on behalf of IFA. So that's kind of the steps and the roles and responsibilities. So in this scenario, the lender, participating lender, which is you all, you assume and have under the agreement, the mortgage origination agreement, full responsibility for the underwriting portion and function within this process, and the disclosures and the loan application and that whole part. That's going to follow all of the regulations and guidelines that you follow for every other loan and investor. But then the master servicer has a role here too. They will, when they are reviewing, you upload a loan to them for purchase, they will review it for secondary market eligibility. So they will make sure that it can be securitized and delivered in pools to either Ginnie Mae or Fannie Mae. All of the loans that come that IFA is able to invest in have to be eligible in the secondary market. And we are not experts in the secondary market at this time. We don't have that competency here internally at IFA. So we have delegated that part of the responsibility to our servicer. So this is all, the point of me telling you all of this is to help you identify who are going to be the people that can help you answer questions that you might have as you do end up going through this process down the road. So by laying out the responsibilities, you'll know that secondary market eligibility questions would be something our servicer would be answering. Then IFA, we are the investor. So with that, we are in charge of setting our rates. We set policies for how you can lock funds and how to make funds available, and what we will consider eligible to purchase. We also do review the loans for that compliance. That's what we call program compliance. So when we're talking about our program rules and requirements, that's what we're going to review for. One of our program requirements is that the loan be secondary market eligible, but we delegate that review to our servicer. But that's just one of our requirements. And then IFA will purchase not an individual loan, but a mortgage-backed security from the master servicer. So that's kind of how we invest in mortgages. So as you can see, we don't get involved directly with your borrowers. We don't interfere in that relationship. Unless we get contacted, we don't insert ourselves in that part. We want this transaction to look as much like it would with any other, to a borrower, like it would with any other lender or investor. So we think this is a really great model to help create and maintain flexibility for consumers. And we really value the partnership, but it depends on us having really great quality partnerships with lenders in order to do it this way. So I wanted to touch on just a few points. The mortgage origination agreement, all of you that are participating lenders listed on our website as a participating lender have had to enter into this agreement. Now I know a lot of individual staff members don't necessarily get the opportunity to review it and become familiar with it. So, and it's a very long document, very technical, and not entirely user-friendly, but it has some key elements that I think every person involved in this process should know and understand. So I wanted to highlight some things here. When we lay out our originator responsibilities within the document, we require that originators offer our programs to all qualified borrowers so that we're on a par with anything else that you're providing access to. So I know a lot of systems have sort of best execution analysis. You run a borrower's application through a profiling system, and they'll spit out, what products might be best suited to your customer. If that's happening, that should be done with IFA as well. And so alongside all your other analysis, you should be looking at IFA programs to see if they could be a good fit for your borrowers. The originator is also, as I mentioned earlier, responsible for underwriting and making sure that the loan is eligible in the secondary market. There is money involved in this. There is compensation for lenders. And at this time, I just want to pull up another resource. This is, again, available on our website. But we have something called a servicing release premium, and that's a portion of the compensation that lenders will receive when they deliver a loan to our servicer. And I just want to let everyone know, because this is really important for people involved in the process, that the amount that your company is going to make is going to depend on how quickly you deliver a complete and purchasable mortgage to our servicer. So the price that we pay for it goes down every 30 days after closing. And so this is the grid that you could follow to kind of estimate how much money your company can make on a given mortgage just through the servicing release premium. And so you'll see it varies by the loan size. It varies by whether it's government or conventional, but we don't break it down within government, so it's just one price for a government loan, one price for the conventional, but then varied by the loan size and as well the timing of the delivery. So I just want to point that out because it does really get to be an important factor for a company's willingness to continue using our programs if they get not enough of a release premium to offer it. So the sooner you get your loans delivered, the better. The other thing, and we can go back to the training slide. Thank you, Beth. The other thing to be aware of in the mortgage origination agreement is that it does allow the lender to charge up to a 1% origination fee. It does not require that that fee be charged, but that is meant to be combined with the servicing release premium, the total compensation for the lender's role in underwriting and originating that loan. So, so those two things are combined, and I think it's not required that a lender charge the 1% origination, but if they don't, they should take a look at that release premium to see are they getting as much as they should or need to get on that loan in order to make it worthwhile or at least cover costs. I just wanted to make sure everyone had that information. And then I have just a sort of slide that's a picture for those people that are very visual to think about how our compliance works. It really is like a layered cupcake, and it's all the different things have to be considered. So we have the Iowa Finance Authority as the investor. We have some program requirements that have to be met. The master servicer is going to be having their requirements, which would be related to secondary market. They're going to be reviewing it to make sure it meets their interpretation of secondary market. You as lenders, you also have your requirements. You don't just approve every loan that comes in the door. So you have a certain set of criteria as well. And then our guarantors, Fannie and Ginnie, they have the main lion's share of the requirements around what loans can get purchased or not. So we're layering all of those things, and when you look at those layers, you may have certain criteria that are at different levels within each investor. So if you have a minimum, for example, credit score, it may vary between those. And in that case, where there's variability between the criteria of the various layers, you're always going to want to choose that most restrictive one because you're going to have to meet all of the layers, not just one. So it's just kind of making sure you're keeping those all kind of under consideration throughout the process, so you don't get surprised at the end when you realize something needs to be looked at. So as I mentioned in the beginning, one of the learning objectives is to figure out what programs will best serve your borrowers. So we're going to walk through some slides here that just kind of start maybe a logical process for how you're going to determine eligibility. And really this just is a threshold question here, because you can exclude people if you answer either of these questions with a no. So first, is the annual income below $115,220? That is the highest income limit that we have in our programs. And so if the answer is they're 118, 120, they're well above the income limit in any way, you're not going to have a good fit with our programs. We don't have an option for them other than potentially the military grant funds. But our main financing programs are not going to be a good fit. Similarly, if you can say no, the purchase price is above $316,000, it's not going to be a fit, and you can instantly then exclude them. But if you answer yes to both of those, then the next step really needs to be you checking the rates, reviewing the remaining eligibility requirements, and then moving forward to offer that to your customer if they qualify. I hope we have a little background noise. I'm sorry about that if that's picking up on our audio. So with that, I'd like to pull up a cheat sheet that we have developed, and it's going to be our homeownership program parameters. We'll just give a second for Beth to pull that up here. And I really like the simplicity of this form, because in a nutshell, it really covers all the core questions that you need to be able to answer to determine whether someone meets our criteria for financing. And so, first, as I pointed out, we have income limits. Now, I told you the highest one earlier, so if they're higher than that, they don't qualify for anything. But if they're within that, that there's potential that they might qualify for our first home program. So then you would look to see if their income is under that $67,500, they could potentially qualify for that program. And when you look at our interest rates, you'll notice that our first home has a deeper subsidy. We subsidize that program more deeply because it's targeting some borrowers with lower incomes and potentially lower assets. So we're actually, as a mission decision, we are able to subsidize that program more. So you'll see potentially a higher value in using financing through the first home program because there would be a lower interest rate. And then in addition, more recently, you probably will see, you would see today, in fact, that our First Home Plus, which is our down payment assistance program, which also has a premium, slight premium on the interest rate, that difference is less for First Home to First Home Plus versus what it would be for the Homes for Iowans Plus. So there's some benefits you can get if your borrower meets that lower income threshold. So you want to really look at that carefully and understand what would be the best deal for your borrower. So income is important. Purchase price limit, again, there's the highest one, but if they're below the $258,000 for first home in that first column of gold, you'd want to maybe see about whether that program is the best fit for the borrower and be able to offer that, at least make it among their choices. Eligible properties. Now, we may be a little more restrictive than some other criteria. So, for example, Fannie Mae might allow more than one unit, but for our programs, we only allow one unit, and for immediate occupancy as a principal residence. So that's a criteria we would review in each case. The permitted transaction types that we allow, we do not currently have a refinancing program, and so we only allow new purchases, and our terms are limited to 25 or 30 years. So long-term financing is the only option for the transaction types. First-time homebuyer requirements, they do apply, but only to our First Home and First Home Plus programs. They will apply also with Take Credit, but as I said, we'll be getting into that in January, so it's not really relevant at this moment. But first-time homebuyer requirements are defined as not having owned a primary residence, your primary residence within the last 3 years. So there's a certain way we would verify that as well, and I'll get into that later. But there is no such requirement for the Homes for Iowans program. The types of mortgage products, again, as I mentioned, they all need to be secondary market eligible, so they either have to be government insured, and then our programs there that we allow are FHA, VA, and RD, and then conventional, and we only have two options for conventional. One is HFA preferred, and then HFA preferred risk sharing, which is a no MI product. And those are the only two conventional options that are available, but we really think they are the best option from among those that are suited to our target market. We have credit overlays of, we have a minimum credit score of 640 midpoint. We have a maximum debt to income ratio of 45%, and we do not allow co-signers or non-occupant co-borrowers, as some people call them. So not allowed. Those are our credit overlays, and they are really the only ones we have. Now, I will say that if you meet the other criteria, a loan is eligible in the secondary market, maybe it's an FHA with a slightly lower credit score or DTI above that 45%, but it still qualifies under the underwriting guidelines. We do consider and in some instances make exceptions to those credit overlays. So we're open to hearing your case if you have a situation like that. But we put those out there because that is our preferred set of criteria. As I already mentioned in the mortgage origination agreement, there are some limits on lender compensation. We do allow the up to a 1% origination fee, and then we also do allow up to $450 for the closing agent settlement fee. And then, of course, the servicing release premium that I outlined is part of the lender compensation when you originate our loans. That's what they are, and it's the same across both sets of financing options. And again, in both programs, Homes for Iowans and First Home, we only allow fees that are reasonable and customary, and those are the ones that can be passed on to the borrower under our programs. Now, you may have more restrictive guidelines elsewhere or under the state laws or other policies and regulations, and there's some variability there. So you also, again, have to comply with the most strict guidelines. But for our purposes, we have provided or we have available a cheat sheet that tells you what we consider to be usual and customary or reasonable and customary. And we'll go over that in a little while, a few slides down. And then just to point it out, we also are exempt from the QM and ability to repay requirements. Our mortgages are all exempt. And the final point that we like to make sure is clear at the outset to everyone is that we do require the use of Iowa title guarantee and not other forms of private title insurance. So I think that's about it for the criteria. So we'll bounce back to the training slide. Okay. So when determining whether a borrower meets that income limit or the applicable limit, depending on which program you're looking at, we have a little different way of looking at income than you would typically for underwriting. We are following a federal regulation that's found at 24 CFR 5.609, and it states that all amounts, monetary and not, which I'm not sure what or not means, but that go on or to or on behalf of any family member and are anticipated to be received from a source outside the family during the 12-month period following admission or closing, basically. So this means that we are always required to project, basically from the date of the anticipated closing, 12-month period, the income during that period. So if there are circumstances that are changing, influx, or what have you, a person's relocating or leaving one job, starting another, we're mostly interested in understanding what their income will be once they are here and settled and projecting into the time following their closing for 12 months. That is the mandate of our regulation. That's what we're following. So it may not always jive exactly with some of the ways that you might be looking at things historically or whatnot, or for your borrower, but for underwriting purposes. But that this is the reason we have this mandatory regulation that we have to follow. The other thing to point out is that we also have to include, our definition includes income from assets, and we have some cheat sheets on this that I'll pull up here again. This is where I think we see a lot of confusion potentially with respect to reporting on the 1003. we do find periodically that a lot of these sources that we're supposed to be counting in projecting income are not necessarily showing up on the 1003, and we don't have a separate application. So we may catch wind of it on a tax return or on some other document in the file that comes into us, and then we're asking about that. And so this is meant to be a complete list of the different included and excluded sources. So you'll go through, it's pretty obvious on a number of things where it's the wages and salaries, overtime pay, net income from the operation of a business. But that third bullet point here on this handout talks about interest and dividends and other net income of any kind from real property or personal property where total assets exceed $5,000, income to be counted as the greater of the actual income or 2% of the value. So sometimes if we have a borrower who maybe owns a property, it's an investment property, we may need to take that into account in a situation like this. It's worth more than $5,000, and we have to count a minimum 2% of the value of it. So there are kinds of situations where often we don't get that information up front, and it can be a thing that we have to follow up on after the fact. So that's just for your reference. I think it's important to go through it in detail and try to make sure that you've accounted for all these things that you're aware of that might apply to your borrower. And this second side of it, or I guess it can be printed in front and back, or it's page 2, whichever way you do it. This will talk about what assets to include, and then there are some excluded assets as well, so you can just kind of have that cheat sheet at the ready. And then I would like to switch to the resource tool that we have on our website that deals with verification of these items. And here you will find that we've tried to list out all the different types or sources of income, as well as the borrower's status, whether they're a first-time buyer or an exempt veteran, what kinds of things. So the type or the source of income or status that we're trying to verify is on the first column, and the last column to the right is going to tell you what kind of documents we would want to see to verify those items. So you'll see here employment, business income, asset income, where we're going to be looking for that and what we might need. Some of what we need we'll have to determine once we get the initial information. So it's not an all-inclusive or exhaustive, but this is to help give you an idea so you can kind of plan ahead and anticipate potentially what we might be needing and why. So it's also just, sometimes there's frustration, I think, when it's not clear what we're going to need or why. And if you have this definition, hopefully it can help you be aware and expect some questions from us on these types of things that may or may not come up in other contexts, but do when you're dealing with a bonds program like ours. We'll go back to this slide. So when you're calculating borrower income, again, it's going to be projected for 12 months following closing. You want to use all sources, even those not used for underwriting. We're typically looking at best case income, and we want to be realistic best case, not crazy best case. But so we are open to hearing from you if you think what we're doing is not realistic, and be prepared to share your reasoning, and we would take that into account. We want it to be as fair as possible, inclusive as possible. So as long as we have some due diligence to show your rationale, we sometimes can see it different ways. But our initial effort is to look at the best case income. A lot of times with underwriting, looking at worst case. So this is going to put us in conflict sometimes with what you've been doing for other purposes, and just kind of keep that in mind. We do review all the documents that get uploaded, and again, we'll be doing the pre-close compliance process in detail later at our next session. So I don't need to get into that in great detail, but when we do look at those things, we are not able to offer an approval. We're really looking at an advisory review, so you'll have to pay attention if you submit a packet to us for compliance and you have conditions that relate to income, because it could mean that even though we're going to accept it after closing, you'll have be able to take your time getting those things together and uploading them. We're not going to hold up your files. If they're related to income, you want to just be cautious if it looks like the borrower could be over the income limit, and just to make sure you nail that down prior to closing best you can. And if you have questions, always ask us. So that's just on a caution on income eligibility. Because sometimes if we don't hold up the file, that can be interpreted as approving it, and we just want to be clear that we aren't really officially approving it at that stage, just providing you feedback. So I also do want to point out that when we're looking at whose income counts, we want to let you know that the income of the borrower and the borrower's spouse, plus any other title holders and their spouses, but not necessarily, that's not necessarily the same as all adults in the household. So just being aware that we're talking about the borrower, spouse, and title holders. Okay. So I think we talked about, you know, how you're approaching the decision about what programs to use, because you're going to be looking at that program parameters table to figure out whether they qualify, and if they qualify for first home, you're going to probably see that having the lowest interest rate. And today, if you were able to offer them that, it would be the best, potentially the best option we would have available. But I just want to put a caveat out there that once we roll out our MCC program, it would be good to note that if they qualify for first home, they will also qualify for an MCC. And if it's an either-or proposition, you might want to just take a look and see what our Homes for Islands rate is, because they can't use an MCC with first home, but they can use an MCC with Homes for Islands. And so in that scenario, you may want to look at the higher rate product if it can be paired with an MCC, and that still might work out to be the best option for the borrower. But right now, all things being equal, the first question is really, do they qualify for first home, because we don't have MCCs right now, and if they do meet that, then they could get the best interest rate on that program. So that would be the consideration to have. The other question you're going to want to really understand is, does that borrower absolutely need the DPA? Because there is a premium on a mortgage, you know, interest rate, and so it's costing them, and over time, you know, if they stay in the home for a long time, they could end up paying more. So you want to make sure they understand that. And if they plan to swap it out, I think we estimated that our down payment assistance breaks even at about 7 years, but you'd have to do that analysis depending on the rate and the day. So, but borrowers should be aware of that price that they're paying, and only make it if they need it. And then the third question is, you know, really to tackle that line of benefit for the military homeownership. If you're working with a veteran or a service member, you definitely want to know that. For a couple of reasons. One, they might qualify for the Military Homeownership Assistance Grant, but also if they're not a first-time home buyer, they could qualify as an exempt veteran, so for our program. So you just want to, you know, always be asking that question as well. So the tips for matching the borrowers to their best product execution, one, of course, is to compare both the interest rate and an MCC if those are available before you lock the loan. You want to make sure you consider the costs of the DPA before locking PLUS programs with 100% financing, because if they don't actually need it, you can still use those programs, but just maybe knock down the loan amount to account for, just go ahead and lock down have them pay their down payment themselves and lock down the rate. So as we already mentioned, the types of loan products we have range from all the various government products and then into a couple of unique conventional products. I've put together this grid that kind of helps you compare them at a high level, what really they have to offer. And you almost have to go case by case to see which borrowers could benefit. I think a lot of times there may be a little bit of a knee-jerk reaction. You have a borrower, first-time buyer within a certain income parameter and credit profile, and you think, obviously, they're going to go government. Well, these programs, these products that Fannie Mae has come out with are getting increasingly usable by that FHA typical borrower, for example. So you may want to just be sure you're double checking that if they do meet the criteria for HFA preferred or the risk sharing, that you are comparing those two options, because it may well be that they could benefit from using the conventional options that we have. And so it's just sort of what's the interest rate, lowest is on the government, but of course they have the insurance costs, which are substantially higher than even our HFA preferred risk sharing, which is a no MI product. So, you know, those are kind of the trade-offs, and this is meant to help you pull out those trade-offs and present that to your borrower and help them understand their options. Let's see. I think we have a conventional product matrix. So with that, I'd like to open up a cheat sheet that we have. We have a conventional product parameters table, and this shows side by side the graduated MI program, which is the HFA preferred, as well as the risk sharing, which is the no MI. And so you can see on the different parameters, income, eligible properties, the loan to value, and combined, all of those things you'll see here. And this is just your cheat sheet to know what is applicable. And I will say, for those of you that have been through this drill before, one of the changes that Fannie Mae has made is they're now launching this new replacement for the My Community Mortgage, the Home Ready, and it's coming out in December. And with that, they are, this table used to say no co-op and no manufactured housing. Well, now they're saying manufactured homes that meet the standard selling guide requirements are going to be permitted in these programs. I think that's good news. We've only had a few questions about it, but it's always nice to be able to be as flexible and accommodating as we can be on these items. So that's new, and that's that second line there, eligible properties. So you can refer to this. This is an updated sheet, hot off the presses today, and actually just got it from Fannie Mae today. So we've been waiting for that confirmation on manufactured homes. So that is one new thing. So those of you that were looking for something new, there you have it. And we'll go back to slides. Okay. So, and just to reiterate, it seems as though our conventional products, we spend a fair amount of time on them because I think government products are pretty well understood. But since we're the only ones that have these HFA preferred, the no MI product, we tend to spend a little more time talking about it just to make sure everyone understands the benefits of them. Again, we just taken a chance to list out some of the key features. What we have found is that they can offer lower monthly payments to borrowers. So if you're looking for a borrower that really needs to meet a lower monthly payment amount, needs a lower payment, that's going to be the time you're going to most see an opportunity here. So I think that's the key point there. Now just to talk briefly about our down payment assistance. Again, we have the $2,500 plus grant, the $5,000 military grant. Both can be applied to reasonable and customary closing costs. And if we can pull up that, I have the little asterisk on the bottom of the slide, refer to our policies. So these are, again, all of these cheat sheets are available on our website, and we'll be packaging them up into a supplemental packet to go with this training slide, these training slides, so that you have all of this information at your fingertips. So this tells you what is our regulatory requirement on the top, what definition are we obligated to follow, and then below that it gets specific. So it talks about what kinds of things we would consider eligible, well, one, for our programs, so that you can have comfort in knowing that you're within the boundaries of our eligibility. So I think that's pretty much it. So you can see the list there. We'll move. And just to emphasize, these funds are provided as a grant, not a loan. There's no second lien, no repayment requirement at all, or recapture provision of it at all for future. The pre-close, it does require a pre-close commitment of funds. The two can be combined. So the PLUS grant can be combined with the military grant and vice versa. But what's unique about the $2,500 PLUS grant is that it is continuously funded. It's not subject to the legislative approval. So we always are offering it, and it's just that extra option that you have if a borrower really needs it. Just to touch on the military program, I showed you that military dollar brochure. That's a great thing to keep at your desk or to hand out to people if you need it. We have some on glossy paper that we can send you, so feel free to contact Beth or me, and we'll get you your own stash. This is a great program, and you have to be an IFA participating or facilitating lender, but mostly it's exclusive to our participating lenders. And again, in the red bold, we want you to be sure you get these approved by us before closing. That is a requirement, and if it goes out without our approval, it can result in not getting those funds back. So you don't want to be fronting funds that you don't get back in the end. So again, there's the MHOA brochure that you can refer to for more details about eligibility. I think we've gone through this mostly. And there's some things that you cannot use our grant funds for. And so I really think this slide is important to keep in mind. It's one thing to list out all the things you can do, and another to have some really key things we don't allow. So we don't allow grant funds to be used for anything that's not on the list of usual and reasonable. We don't allow the grant funds to be used to make a principal reduction. Satisfaction of other debts or liens are not allowed. We don't allow the funds to come in before all other sources have been applied. So if you have closing costs paid by the seller, other kinds of sources, they have to be first money in the deal, and they have to be used fully before our funds are used. And so we would potentially reduce the amount we contribute if other sources are sufficient. We don't allow our funds to be given as cash back to the borrower, and they can't be used for the purchase of personal property. So if there are items that are considered personal property coming in with the purchase agreement, we would have to back those out. Have the borrower provide their own funds for the purchase of those items. And we don't allow for the purchase of excess land or additional real estate. So multiple parcels, if there is a second parcel that's not necessary for the livability of the home, that second parcel would have to be paid separately with funds of the borrower. The plus funds couldn't be used. There is a subsidy calculation worksheet that's available for you in Lender Online, and hopefully it walks you through so that you don't accidentally allow some of these costs to go to be paid from the grant and then not be reimbursed after the fact. So we really recommend using that. And we do have, we're more than happy to review your calculation and your HUD prior to closing if you want a second set of eyes, just to make sure you haven't missed something. Sometimes it can be tricky if you don't do it all the time. So we do recommend if you're rusty or new to it, that you just walk through it that first time or two with us. And every lender has their designated staff person, so that person will be your contact to go through the subsidy calculation ahead of closing. And with that, I think we're ready for questions. So I think we can open up the call.
If anyone would like to raise their hand, we'll call on them.
Yeah, if you have the menu board, you can raise your hand.
And then I'll check for questions. So. Open this up. Oops, sorry about that. Please bear with me with my technological skills here. I'm trying to open this up a little wider. There we go. So the first question is, what are the requirements on the no MI option?
Well, you would need to refer to the conventional matrix, and we can maybe pull that up again.
Yeah. I'll have to go back. Open it up. Sorry.
Well, that's the second question. That's okay. We just
there we go. There we go.
So I think the biggest thing to point out about the HFA preferred is that it was just simply a variance. So it followed My Community Mortgage, as it says in the note at the top. It followed My Community Mortgage guidelines with certain variances which are included on this table. So really, in that, up until December 1, you're following My Community Mortgage, and then with Home Ready, now that's replacing My Community Mortgage. So now it's going to be follow the Home Ready selling guidelines, and with these variances. So most of the guidelines are going to be similar to what you're following anyway, and the requirements. These are the only things that would be different, potentially different from what the other My Community Mortgage or Home Ready Mortgage might be doing just without the HFA preferred option. The main difference, I will say, is with this, you can use our income and purchase price limits, and with their My Community Mortgage or Home Ready, Fannie Mae has income limits that are lower, I believe, than our Homes for Iowans limits. So it theoretically gives you a broader market. Also purchase price limits. I believe they have a lower limit on their Home Ready than what we allow with our Homes for Iowans. And so you can follow our limits and just serve a more expanded market. That's one thing. But basically, this is it. So you can go down, the No MI risk sharing is on the right, the far right column, and you can see exactly what variances there are for that product within the Home Ready or My Community Mortgage Guidelines. So we can show, the other next question is, can you show us where we find these forms on the website? And let's walk there, Beth, if we can.
Sure. Keep in mind, I think this form that Deb, that we just showed you, changed just a little bit, and we don't have that form on the website yet.
We will.
But we will, yeah.
We'll have it in 2 places, actually. So for those of you on the training, like I said, we'll take all of these things that I'm referencing today. We have them all in a little folder. We'll put them together in a PDF document and attach them in one little bundle for you. So you'll be able to get exactly what we went over today.
So we're getting onto our website, iowafinanceauthority.gov. And I'm going to move the questions out of the way for just a moment. And information for lenders. And then scroll down to Forms and Resources, a little farther down, Forms and Resources. And on your left-hand side under Resources, you should be able to find all of the forms that Deb was showing you today, and a few of those will be updated a little bit after this training.
Yes. So you'll see the Military Home Ownership Assistance Program flyer is there, the Home Ownership Program brochure is there, the IFA Home Ownership Program parameters, income eligibility guidance, eligibility verification documents. Those are all forms that we went through today. There's some others that we didn't go through that will be dealt with in later trainings, but those are some of the ones we went through. And then the conventional product parameters is down there. That's the one that is not yet updated, which deals with conventional. It simply doesn't reflect the change on the manufactured housing criteria. However, that will be uploaded after our training today. Now, we can maybe show where the training materials will be posted, because we will also post those here.
So as you see, there are presentations and new lender trainings. So it should take the place over here of this latest new lender training in August. So the newest training should always be over here in this, under this bar. So that's where it will be as soon as we have our communications department post it.
And we may be able to email it to the folks that logged in for the training today, just so that you get it directly sent to your inbox and don't have to come out and navigate to find it. But I think that's so she can do that. So we'll plan on having you sent the slides and these attachments or these reference tools today. But in the future, if you need to reference them, we do periodically update them, just like I did today. So you probably want to, refresh your records reasonably regularly, and here is where you would find to do that.
Back to the question.
Can I just add something in on that? What are the requirements on the no MI option? With the mortgage origination agreement, there is a separate HFA preferred risk sharing no MI addendum that has to be signed and in-house before you're actually able to offer that program. So if you're not sure if you can, feel free to reach out to your loan production specialist, and they can let you know if that addendum has been signed.
Okay. So the next question is, are condos eligible? Do they need to be listed on the Fannie Mae site to be eligible, or is our spot approval okay?
That would be selling guide. You would follow whatever you would under the selling guide. We don't have any additional requirements around condos ourselves, so you would do whatever Fannie Mae is instructing you to do on that front for the selling guide.
And the next question is there a time frame that applies to having the closing disclosure reviewed for grant parameters?
Again, I think that you would follow secondary market guidelines with relationship to that. So we don't have a specific closing disclosure that we require here in-house, so you would simply follow those secondary market guidelines.
But that is part of your closing package, since that replaces the HUD-1. So that does need to be we want a complete package within 30 days, and we'd like to have that in-house within 10 days.
Right. And if your question related to review of the settlement statement prior to close, we do ask for that at least for 24 hours response time. You know, if you're asking us to review that statement for plus calculation or military grant calculation.
Yeah, so that would be 24 hours. We would like to have that much, and
right.
we will do what we can to accommodate your time frames. But if you can give us a day, that's great.
I'm going to check and see if anyone has their hand up real quickly here.
Those are great questions. Thank you for them.
Excuse me. It looks like everyone who had a question was on that list there. Okay. Yep. Yeah.
Okay.
I don't believe, I'll check one more time the questions. Don't see any more.
Okay. Well, that's great. Thank you all. Feel free to email us. I did include with the slides that Beth will send out here shortly our email contacts on the last slide. So if you have other things that come to mind after the training now, feel free to shoot them to me or Sherry or whomever you choose. If you have other contacts you prefer to work with, we're all here to help. So please let us know if you have questions. And really, I just want to thank you all for joining us. I know you have a lot on your plate, a lot of big changes and things. And our goal here is really to try to beef up our training to help eliminate uncertainty and confusion and frustration for you, because we know you have enough other changes going on that you don't need anything with us. So I hope that the series will help to accomplish that, and we really are taking seriously our need to help support you more throughout this transition phase. So thank you so much for working with us and being patient with us, and we really appreciate the partnership, and have a great rest of your afternoon.